Welcome to the heart of darkness, where the streets whisper secrets and every corner holds a tale of intrigue. Prepare to immerse yourself in the pulse-pounding world of crime as we journey through the labyrinthine streets of capital crimes. We are uncovering the Parmalat, a multinational dairy and food corporation involved in one of the largest corporate accounting frauds in Europe. So here we go. Parmalat, a family-run dairy and food company, was a major player in Italy's dairy and food industry. The company's financial performance began to slip in 1990, leading to management's decision to disguise the issues through fraud and collusion. During this 13-year period, Parmalat executives used various unethical techniques to extend the fraud, including creating fake transactions, using receivables as collateral, creating fake assets, and taking on legitimate debt. They also worked with investment bankers to engage in financial engineering, moving debt off the balance sheet or disguised it as equity. They even colluded with third-party auditors and bankers to finance the fraud indefinitely. Problems at Parmalat began to emerge publicly in mid-2002, with credit spreads widened by 250 to 300 basis points between July and December. Tightening credit conditions in Latin America and the default of food industry rival Cirio in 2002 drove the rising spreads. By December 2002, Merrill Lynch analysts Joanna Speed and Nick Sochowski downgraded Parmalat to a sell rating, citing the company's ongoing reliance on funding from the debt markets despite having considerable cash on the balance sheet. Analysts at Parmalat, a company, argued that holding large cash balances with little interest and substantial debt with higher interest payments represented inefficient balance sheet management. However, it was later revealed that the company's reported cash balances were fraudulently inflated and its debts were massively understated. The investment community largely missed the fraud, with only the Merrill Lynch team issuing a sell rating. One analyst from Unicredit Banca Mobiliare also expressed concerns about the company's debts. Parmalat faced a scandal in 2003 when CEO Callisto Tanzi filed a complaint with Italian financial markets regulator Consob, accusing major banks of slandering the company. The complaint revealed that Parmalat's stock had fallen due to the withdrawal of a €300 million bond issue. In March 2003, Parmalat produced a forged verification letter on Bank of America letterhead, validating the account and submitting it to the auditor. This led to the discovery that the Bonlat account did not exist, causing controversy. In November 2003, Deloitte and Touche refused to sign off on Parmalat's half-year financial statements, causing further confusion. In December 2003, Parmalat defaulted on a €150 million Eurobond payment, leading to a downgraded bond rating and a 40% stock price. Tanzi stepped down as CEO and hired turnaround expert Enrico Bondi to resolve the crisis. PwC found that Parmalat's financial statements had been misstated since at least 1990, with positive and growing earnings every year from 1990 through 2002. After properly restating the financials, PwC revealed that Parmalat had actually lost money in 12 of those 13 years. Parmalat was declared insolvent on the 27th of December 2003, and CEO Callisto Tanzi was indicted for fraud and arrested. The growing risk of Malat fraud in the financial sector. The Parmalat fraud is a common occurrence in the financial sector, where companies attempt to hide losses by using fraudulent means. Executives like Tanzi and Tonner use deceitful tactics to bring in extra cash and disguise these actions from the outside world. These tactics are often a direct result of pride, and Parmalat's case first manifested itself as a debt crisis before being revealed as a fraud. Tonner devised a double billing scheme to inflate Parmalat's revenue and assets by selectively duplicating invoices in the name of the shipping company that delivered milk. This increased reported revenues and accounts receivable, which were then used as collateral to obtain loans. The loans increased the company's liabilities and cash. However, this tactic only escalated the original problems over time. If a company reports revenues of $100 but has revenues of $90, it might still have costs of $92. If the company takes on $10 in debt to fill the gap, it can feign profitability so long as it can continue to pay off the debt. In the case of a chronically unprofitable company such as Parmalat, the problems introduced by taking on too much debt must ultimately meet their day of reckoning. The company also took on debt disguised as equity through complex transactions with Wall Street. For instance, in a deal with Deutsche Bank, Parmalat entered into a collateral swap agreement that allowed the firm to borrow money and record those funds as equity on its balance sheet. In 2002, Parmalat's Brazilian unit issued a €500 million convertible bond that was automatically convertible into Parmalat company shares. The security paid interest of 10.45% and was backed by promissory notes from the parent company and a long-term purchase agreement for the shares. A fraud of Parmalat's scale almost always involves contributions from many parties. According to employee Claudio Piscina, as many as 300 employees were aware of the company's double billing scheme. This phenomenon is made famous in the Milgram experiments, where subjects were asked to administer electric shocks to participants, actually actors, when they answered questions incorrectly. Participation in a fraud is not strictly confined to a company's employees. In 1997, Parmalat's lead auditor, Grant Thornton International, GTI, noted a hole in Parmalat's books amounting to €5 billion. GTI conspired with management to hide the fraud from the firm's new lead auditor, Deloitte & Touche, when it took over in 1999. In other words, Parmalat executives colluded with many people to bring in the capital they needed. Parmalat was found to be involved in a scandal that involved the creation of a complex ownership structure that relied on special purpose entities, SPEs, to create illicit transactions, disguise these transactions for reporting purposes, and hide debt. The company's apparent acquisition strategy allowed it to pick and choose how to consolidate expenses, creating SPEs in the Cayman Islands, Dutch Antilles, and Malta, and even creating one called Bucanero, meaning black hole in Italian. The company transferred uncollectible receivables from consolidated subsidiaries to these SPEs, created fictitious trades at subsidiaries that were generating losses, recorded non-existent repurchases of bonds, and sold receivables falsely labeled non-recourse, meaning that the buyers could put the receivables back to Parmalat, so they still bore the risk of ownership. In total, the company hid €12 billion, $15.2 billion of debt, and kept it off the balance sheet. The corruption was so widespread and long-lasting that multiple red flags should have appeared for multiple people both inside and outside of Parmalat. As an outside investor, there is no magic bullet to avoid this sort of scam in the future. Effective due diligence always has a limit, and only vigilance by all interested parties will bring about a swifter discovery than in Parmalat's case. Awareness of how other companies perpetrated their scams can provide a good starting point. Thanks for tuning in to another eye-opening episode on capital crimes, where we uncover the truth behind the dollars and cents. Before you go, fam, remember this: knowledge is power and action is key. If you're as passionate about uncovering financial wrongdoing as we are, then don't forget to drop a comment below with your thoughts, smash that subscribe button, and share this video with the squad. Together, let's keep exposing the dark side of the financial world and keep chasing the truth.